When a successful trader starts to gain third-party investment into their strategy, there's something that very often occurs. The trader starts to change their behaviour. The reasons for this are psychological in nature and are often down to the additional pressure to perform well and produce good returns for investors, and also the additional fear of producing a loss for those investors. Before being in this situation, many traders would probably consider that this would never happen to them. However, when you're in that situation for the first time, the psychology of the brain can be harder to control than previously thought. But there are things you can do to help. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. The way that our brains operate and the psychological influences on our behaviour are things that impact every aspect of our lives and the choices that we continually make. And trading, especially when you're managing someone else's capital, is certainly no exception. Let's take a look at these psychological influences and what you can do about them to become a better fund manager. The psychology of trading is something that we mentioned briefly as we were looking at the trader evolution and the path that traders often take from being an aspiring trader to eventually becoming a professional trader, potentially attracting third-party capital. And the first point at which this particular aspect of trader psychology came in was at the attracting seed capital stage. And then again, we saw this appear in the attracting third-party capital phase. And so let's now dig into this in a little bit more detail. So meet the trader. He is dedicated to his work, he's very hardworking and competent and diligent in everything that he does. And with enough time and effort, this trader will start to produce very good trading results. And if this trader has a publicly available track record, they're sure to attract the attention of potential investors. And this, of course, is a good thing, because as we've seen before, the use of investor leverage is a far superior way to earn a living from your trading than the alternative of over-leveraging on your own capital. However, it can feel like you're under scrutiny once those investors have come on board. And this can, for some traders, become a relatively daunting experience. And let's take a look at some of the things that can now change. And these, of course, are caused by the psychological impact of having those investors and trading with that additional capital. Suddenly, there will be a pressure to perform, unlike there ever was previously when you were only trading your own capital. And very often this can cause a change in your trading behaviour. So there are many more, but let's just look at a couple of examples of how this might happen. In the first example, let's imagine you have a position which enters profit, but where the price of the underlying asset is at the moment, it hasn't yet reached your profit target. However, you make a decision to close that position now anyway. But why would you do this? Well, with this added pressure of investment capital, at the time it seemed like a good idea to lock this profit in. Why? Because you know that your investors will see this profit on their equity, and clearly you think that they will look on that favourably. And by locking that profit in now, means that you will guarantee that your investors make a profit based on this particular position. And one of your primary aims now, of course, is to keep investors on board, to keep them invested in your trading strategy. And so you feel that this justifies your actions. Now, what your investors are actually thinking is something you can't know, but this is what your brain tells you they'll be thinking. And the feedback loop here is that this makes you feel good. However, all that's happened in reality is that you have changed your strategy's rules. And if your rules were specifically designed to achieve optimal performance from your strategy, that will sadly no longer be the case. And so yes, you might have locked in profit for your investors for this position, but in the long term, this is going to have a detrimental effect on the return that they receive. And it's actually quite possible that if you continue to behave in this way, it might mean that those profitable trades no longer offset the losing trades that you have, meaning your equity curve suddenly flattens off. Let's take a look at another example. But this time let's consider a position that enters a loss and is actually approaching your stop loss. And because your psychology is slightly different now with investor capital, you come to the conclusion that if the position were to hit the stop loss, this would guarantee a loss for your investors. So what do? Well, you might decide to move or even remove the stop loss. But why? Maybe you're convinced that the position will eventually recover and achieve a profit. And so psychologically, you're fearful that locking in a loss now will upset investors and will make them start to doubt your skills. So again, your psychology starts to make up stories about what your investors are thinking about you. And this has a negative impact on the way that you feel. But all of this, of course, is made up in your own mind. Let's look at the facts of what's actually happening here. Because you've moved your stop loss, or maybe removed it, then yes, you might get lucky and the position might recover. But if you've recovered from a large loss, very often psychologically there's a tendency to close the position as soon as you break even. And it's that pure relief of coming from a situation where you've been in a large loss and now you can close the books on this position as though it never happened. However, if the opposite happens and the position doesn't recover, then without a stop loss, things can now start to get really bad. But the reality behind all of this is that generally speaking, investors are usually comfortable with small drawdowns. They're not coming into this blind. They realise that small drawdowns are just part of investing. And remember, these investors invested in your strategy in the first place knowing that you had drawdowns, because they'll have seen your equity curve. But the reality is that investors are not comfortable with larger drawdowns than they've seen historically. And so by removing a stop loss or moving it means that this is much more likely to happen. And so the bottom line here is that you need to stick to your rules and keep this in the back of your mind. It's these rules that attracted investors initially. But what can you do to help you with this? Well, I have two suggestions. The first is around the concept that to be forewarned is to be prepared. Try to anticipate the feelings and emotions you will get as your investor capital starts to grow. Maybe even rehearse them. I used to work in a university sport psychology research department, and we worked with elite athletes from across the country. Athletes that were at their pinnacle of their careers. And one thing that all of these athletes had in common is that they rehearsed their sport in their minds. And they did this again and again. And by doing that, it prepared them for the actual event of competing in a sporting event. And so, is there any reason why we, as traders, shouldn't do the same? If you expect the feelings and emotions, there's a lot more chance that when they do actually appear, you'll be able to handle them well. And this is what might enable you to stick to your rules, because your rules are your parachute. It's those that will save you. Something else you might want to consider, and this is a lot more practical in nature, is to start competing on the Darwinex seed capital allocation program. Now, the name we give to this is Darwinia, and every single month Darwinex invests up to €7.5 million in the best 120 strategies. And if you as a trader can then make a profit on that capital over the next 6 months, you'll earn a 15% success fee. But how will this help with psychology? Well, it will give you the experience of managing capital, but rather than from a third party, you'll be managing capital directly from Darwinex, and there's a much lower pressure and risk. But what it will do is start to give you that experience so that when you do get other investors coming along and investing in your strategy, you'll be pre-prepared for many of those emotions. Now, in the next episode, I'm going to take a much closer look at Darwinia and cover all of the ins and outs of this monthly competition, look at the criteria to enter, and consider the factors that will get you onto that leaderboard. So be sure to tune in for that. If it's already available, you'll see it top right. But now, until next time, trade safe.